Barrel rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello, I'm Professor Code, and this is a video on the importance of market activity and compression and extension theory. So what's all this about then? Well, if you remember, the models are based on the four complexes, particularly from the daily perspective, the daily analysis, but we actually have 8 complexes, full complexes, but let's just concentrate on the 4 core complexes. So the 4 complexes are the dollar, the euro, the yen and the pound, and you know that each complex is made up of the pairs of the other 3 components. So for example, the dollar complex is made up of the euro dollar, which is of the euro dollar pair, the dollar yen and the pound dollar. So those 3 make up the dollar complex. The euro complex is made up of the euro dollar, the euro yen and the euro pound. The yen complex, dollar yen, euro yen, pound, what's that, not pound dollar, oops, made a mistake there, pound yen, and the pound complex is made up of pound dollar, euro pound, pound yen. Now that's the starting point, if you like. So complexes are made up of 3 FX pairs in the core situation, and those FX pairs, remember how we calculate them. We look at the points movements and then translate them into the complex itself. So dollar moves. So if the euro dollar minus 20, that would be plus 20 going into the dollar because the euro's lost 20 points or pips. Anyway, if you're not sure about that, go back to what are Forex complexes and how to calculate them. Anyway, so those are the complexes, and what this compression and extension theory is, basically it's a method of finding out how far these complexes are either in extension, how far they are apart, or how far they are compressed. So for example, the euro complex and the dollar complex, are they fully extended, somewhere in between, or are they fully compressed? And if you know the nature of the compression and the extension, then you're in a very strong position to decide on the turning points of the individual pairs. So that's the first thing. Right, so and what do we mean by activity? Well, market activity, if you remember, and if you've seen the daily briefings, we tend to sort of write them up like so. I don't know, just an example: euro, dollar, pound, yen, whatever. And then we've got the figures along the bottom and the drivers, etc. So it could be a positive opposed driver there, positive rock, negative mover, negative secondary driver, and then on the left hand side or wherever we write plus or minus, say 120, and that basically is a measure of market activity because it's derived from the negative side of the equation, if you like, and the positive side of the equation. So those two will basically combine to make minus 120, and those two will combine to make plus 120 in this example. So that's that. So that's within a situation with an opposed driver. Obviously, if you've got an unopposed driver, the situation is either like this. So we've got, I don't know, say dollar, euro, yen, pound, or you've got this situation. So you've got dollar, euro, yen, pound as an example. So you've got unopposed, in this case it's an unopposed negative driver, so it's unopposed, and this is an unopposed positive driver. Unopposed positive driver. So market activity in this case is plus or minus whatever the driver is, because these three. So for example, in this case, this might be minus 120 again, and that means that these three complexes will add up to plus 120. And likewise, if you've got a positive opposed driver, you could have plus or minus plus or minus 120, and that means that the dollar in this case would be complex would have moved plus 120, and these three would add up to minus 120, thus giving us symmetry in the modelling and balancing out the equation. So what we're going to do is we're going to stop this a minute and then restart it after I've drawn something up on the board. So don't go away, I'll see you in a minute. Right, welcome back. What we've got here then is along the horizontal axis, we've got, this is 01 to 12, which is months. So that was for 2020, if you like. And then this is 2021, the new year. So this is January 2021. And what this scale is basically is the activity level for the individual month. So this is the plus or minus, if you like. So these are monthly plus or minus values for the modelling. So for example, in March, the third month, let's just stick this over here. So March, the third month, what did we have? Let's have a look. The third month we had plus or minus 962. So this is around 1,000. I mean, it doesn't really matter, and this is around 2,000. So in terms of plus or minus activity, so these are monthly figures to bear in mind. So and then the peak here was corresponded with the seventh month, which was July, which was 2,248, plus or minus 2,248. So plus or minus 2,248. The figures, don't get too tied up in the figures, it's the principle that's important. So basically what these are then, these are the plus side of the equation, and this is the negative side of the modelling equation, and obviously it's a mirror because the plus side has to equal the negative side in terms of the formula. So we've got like an opposing mirror. So if you've got plus 2,248 for July, the month of July, you've got minus 2,248 here. So they correspond. Now, remember what we're trying to do here. We're trying to model and see the importance of market activity as a metric for telling us how compressed or extended FX complexes are, and then by extension how an individual FX pair is likely to react from that information. So if we look at this then, and we can see that, so this is a measure of volatility, if you like. So this is an alternative measure of volatility. So you can see that in July we had a maximum, we had a spike in market activity or volatility, if you like, and then we've had varying degrees of minor spikes and highs and lows since then. Now, how does that fit in? Well, when you actually do a cumulative plot of each complex, so for example the dollar complex, bear in mind it's made up of euro dollar, dollar yen, pound dollar. if you combine those and do a cumulative plot of the monthly values as a accumulation, so in March you'd have a figure, and then let's suppose it was plus 300, and then in April you've got, supposing you got plus 200 for the dollar complex, then you'd add the 300 and the 200 and you get plus 500 for the April figure, because that would be March plus April, and you end up with a cumulative plot for each complex. Now if you do that, you end up, well, I'll just draw it roughly. So the dollar then, the dollar actually looks something like this. So the dollar, I'll do it in a dotted line. It doesn't really matter exactly, but it gives you an idea. And you get this sort of situation for the dollar. So the dollar, I'll draw it in like so. So, and we'll do a zigzag line just to make it stand out. So what is that line then? That line is the dollar complex on a monthly basis in terms of activity broken down from the three FX pairs on a cumulative basis. So you can see that the dollar, and this is more or less what happened in terms of the modelling. So you can see that we were steady, then we had a big drop in the dollar, we had a bit of a lift up in September, October time, and then we had a floor in the dollar roughly around the end of the year, at the end of December. Okay, and then it started to come up. And if you plot the other three, so all the four complexes in other words, so this is the dollar, you've got the euro, the yen and the pound, you end up with things crossing all over the place. And if I hold this thing up for you, you'll see basically what we're talking about. Let's just get it roughly there for you. Now basically there's probably about right. Okay, now if you look at the blue line is the dollar. Okay, and I know this is not easy to see possibly, but I'm just showing you the principle of it, and I will obviously pass on the information during the daily briefings and whatever. The red line was the euro. So basically, so blue was the dollar, red was the euro, green was the yen, and orange was the pound, and the pencil lines were the original lines we put in for the plus or minus actual activities, which are not cumulative. They're straight. So the three coloured lines, the blue, the red, the green and the orange, are cumulative data, and the actual pencil lines are just a representation of the plus or minus activity rates for monthly flows in the modelling. So I know that probably sounds a little bit confusing, but that's what we've got. Now if you then actually plot the individual pairs on a cumulative basis, you end up with something like this. So now you can see, we'll talk about those in a minute, but basically that's what we're after. We're after a sort of a measure of extension and compression in the complex, and then linking it to the positioning and cumulative points for the individual FX pairs. And remember, there's 6 FX pairs that make up the 4 complexes. So let's just rub that off and summarize what we're talking about then. So how does this help, and how can we use it to our advantage? Well, clearly, if you know the way the market works normally, in terms of activity, the market tends to work in a cycle. So if you've got basically an activity cycle. So you get a base in activity. So and then you get a rise in activity. Where, in other words, and what is activity? It's basically a measure of volatility and movement in the relevant FX pairs. And then it starts to roll over because in this case all the buyers have bought and they're starting to reach a peak, and then sellers are starting to have a go, and people are getting out of profitable trades, and then the market starts to roll over, and then the activity rate on the downside starts to increase. So the short sellers start to really ramp the market down. The long traders are getting burnt on the way down, and then we reach this sort of turning point where there aren't any more sellers, and you get this turning point where people start buying in again, and then the market starts ramping up again. And then you've got this cycle. So that's the activity cycle. So clearly you get a maximum. And remember, this links in with our moving average situation where we're talking about first and second derivatives, and you get an inflection point. So an inflection point, or where you get a change of concavity. So the market starts to bend that way, and then it starts to bend the other way. And this is what's known as an inflection point. And this is a way of recognizing a second derivative. It's the rate of acceleration. It's the change. It's the change of the change. And the first derivative is just a measure of the slope. So its first derivative is speed, if you like, constant speed. Second derivative is acceleration or deceleration. So that links in with that. Excuse me. So you've got we know that if you can get a handle on activity, it gives you a good idea of turning points and how far the market's going to move. So and then from there, if you can get a handle on extension and compression. So if that's the dollar complex and that's the euro complex, and they're fully extended, or this is the dollar complex, and they're basically rammed right up against each other and they're compressed. Then if you know this, then you can relate it to the FX pairs. And remember, these aren't just these are complexes, not FX pairs. So this is euro dollar, dollar yen, pound dollar, and this is euro dollar, euro yen, euro pound. So the crossover pairs are the euro dollar, and then you've got opposing pairs, secondary pairs within each complex. Anyway, so that's that. So then you're in a position to actually decide, if you know the activity in terms of where you are in the cycle, and you know whether you're either near full extension, somewhere mid, or at compression, then you can relate this to the individual FX pairs and you can plot them out, and you get a much stronger view of where the market is heading and where it has been heading. So How are we going to use that? Well, as I said, we use it in that basic structure, and the Forex Super Model, we can pass this information on to you, and actually today, which is the 8th of the 2nd, 2021, we've effectively passed that information on, saying that we're shorting the pound dollar cable because it is at it's fully extended in terms of the complexes, and all this stuff dovetails and ties in. So a lot to take in, I know. Any questions are welcome in the comments, but that's basically what market activity is, and modeling, extension and compression is. So hope that was useful. Thank you very much.